What is up, ladies and gentlemen, boys and girls, loan officers, real estate agents, clients, appraisers, everybody? Gather around. Oh gosh, Rob's already tired of this intro. Welcome to the Monday Market Update. It is your host, Sean Grapevine, coming to you live from our live studio audience here in Atlanta, Georgia. Hello to all my fans far and wide. I am joined here by two legends of the sport. Today we are gathered around to listen to the gospel according to Jon Arnsmeyer. He's from the ridiculously named Kansas City, Missouri. He's graduate of Calvary University, but he leads the cavalry of capital markets. Hopefully, we do not find ourselves atop the mountain of skulls at the end of this volatile week. That's another name for the biblical spot of Calvary, the mountain of skulls. He could fill in as your therapist because he studied psychology while in school. Once again, hopefully unnecessary at the end of this crazy week. And he's always got photography to fall back on. You can see it at johnmark.co, where you will be able to buy some of the photos he has hung in his coffee shop. Also joined with us today, I mean, just going to toss the entire thing. We've got so much to talk about too, so I'll try and make this short. A man who needs no introduction, but he's going to have to suffer through this one. Anyway, he's a noted barbecue champion of the greater Tampa area, a multi-time winner of one of the most prestigious charity golf tournaments in the West Central Florida region. And I'm jealous to say that he looks like what would happen if Rob Lowe and Tom Cruise ever had a baby. Welcome, Rob Pieklo and Jon Arnsmeyer.
Wow. That was a new one.
It's true, though. It's true.
Longer.
Yeah,
well, a little longer. Maybe a fatter version of both, but that's fine. We'll take it.
A handsomer version of both, sir.
Yeah, I will say this. So my camera already has given me the warning sign of being like, hey, I don't know if I'm going to be working today. So my camera gave me the warning shot. So if you see it go off, I'll come back. I'm not going away. It's just my camera's acting up today because I got a fancy camera.
I have the same issue with mine. I have a fan blowing on the camera due to overheating. So guys, without further ado, last week was a doozy in the market. This week promises to be a doozy in the market as well. Markets sort of opening similar to where they were mid last week. Who wants to talk about jobs and more jobs last week?
Rob,
John.
you paper. Yeah. So listen, that last week, Sean, we talked about, like, hey, is it going to be December to remember? That was our phrase last Monday, and it turns out we got kind of that jolt, and we said last Monday that Thursday would be the big one with, hey, what's the unemployment rate? And it came in, and it showed that the market is still resilient. It came in a little bit lower than anticipated, and guess what? That just continued the week of volatility across the board with jobs, which remained flat, but that jobless claim, the jobs report being a little bit lower than anticipated, it hurt a little bit.
But not enough to. I mean, we had some other good news leading into the non-farms payroll release on Friday. A bunch of other jobs news, right? Mm-hmm. And then it looks like I think Monday's close was still was right in line with Friday's close. So we had better and better news, and then we had this like not great jobs report or too great jobs report, depending on whether you're personal.
I don't know if pun intended or not, because it started with the JOLTS report on Tuesday last week, and that's where we got a little bit of momentum going. And then, Friday was good. I think Friday, in terms of the jobs report, like, we needed that little breather. I think we had moved a significant amount. And if we had a bigger beat, I really do. I feel like if we had a 2 handle on that headline number versus the 199, I feel like if we had that kind of beat, you could have seen a lot more, selling in the bond market. It's kind of this weird zone we're in, this kind of Goldilocks zone of what looks to be like a loosening labor market based on the jobs report and the JOLTS numbers that came out, continuing claims. If you kind of take it all together, it's going to be an interesting rest of the month because of what's happening, and what you'll see is limited trading, less liquidity.
I think you've just muted yourself there.
Of course. So of course I did. It's never. I don't even know what I did. I waved my hand and I somehow muted myself. But yeah. So basically, just saying that it's going to be a unusual December, just with liquidity is going to be less. Yeah, obviously we know as we get closer to the holidays, it seems to be more and more extended that folks disappear. the closer we get to the holidays, and there's just going to be less trading, less momentum. People are kind of positioning themselves in their portfolios in a certain spot going into the end of the year, and then really don't see a ton of activity until kind of everybody gets back to work in January. So it's going to be interesting with the data, with the Fed meeting coming up. There's just a lot going on this week that's going to, push the market in a direction probably until the beginning of January.
Sure. Yeah. So speaking of two handles and things this week, we have CPI coming out tomorrow, as well as CPI is tomorrow, right?
That's tomorrow.
And then Fed is also tomorrow, right? Wednesday.
Yeah.
I see. All right. So speaking of which, we're going to have a Fed live. Are we going to have that this week? The Fed live?
We are.
Okay. We are going to be doing a Fed live react, a live stream of a few of us watching, interpreting, reacting to, and generally poorly estimating, what we think the results of the Fed's meeting on Wednesday are going to be.
That's going to be, he said CPI is a big deal tomorrow. I think that's going to be a real interesting. And then kind of the tone. It's always, no one cares about the Fed interest rate decision, to be honest. It's usually always on point. Everyone has a good idea of what's going to happen. The percentages are they're going to stay flat. And then what's the presser going to say? Because right now we're in a spot where, boy, the market really believes the Fed is going to be aggressively cutting rates next year. I
just don't see it.
Yeah.
And if that isn't the case, if there's any kind of, right now, that's where the market is. So it's not about kind of what's going to happen. Actually, if they do cut 3 times, that would be less than what's anticipated and cause this potential reversal in some of the gains that we've had. So like the expectation is 100 to 125 basis points of cuts next year. And that seems aggressive. So the Fed's tone has been that they're not going to be that aggressive. They're not even sure if they're done increasing rates. So that's what their tone has been. But the market's saying, we don't think so.
So tell a layman like me, how are we able to tell what the market thinks the Fed is going to do? I know there's like Fed. I mean, and how precise and accurate is that towards like the market's actual sentiment? Because when you talk to anybody, nobody really thinks that. There's nobody who thinks that, right?
Right. I mean, like this morning, if we're just like looking at today and going into CPI, going to PPI, we had a crazy rally in the stocks. The bonds pulled back quite a bit. There's been a 20% move over the last 6 weeks. And I think the markets are starting to show a little exhaustion depending on the direction they're moving. And so now, as we head into this week, to answer your question, everyone is starting to maybe add some trepidation to those rate drops, those rate cuts. So we're saying, hey, this was great, but maybe let's stop and reevaluate. And that's what we're seeing, especially today when everything's opening flat.
Yeah, and it's all percentages of where money's going for Fed futures, and that's kind of where we get our indications of what's going to be the cuts. So if you were to search, Fed rate projections, you would see there's a Fed Watch tool that kind of goes out and gives you the percentages of where they think the Fed rate is going to be month over month. So you can kind of look out all the way for 1 year ahead. So you kind of see at December, there's a high percentage. The highest percentage is that the target fund rate is going to be in that 4.25 range. If we're at 550 right now, it's 125 basis points of expectation in cuts. So that's significant. And in fact, very few people have it at 475 basis points even. And I'm looking at the chart now and
oh, this is so cool.
Yeah. So that's where you kind of see where the indicators are. And you can't look at just a percentage. You have to look at what is the highest percentage. And that's where most of the money is, and saying that's where the rate is going to be at the end of the year. And it goes by month. So it kind of shows where, or the Fed meeting by Fed meeting. So it kind of goes to where these things are going to be and where the expectation is and what the probability is of it being in that range. So you see that and you kind of see what December looks like. And you're like, holy cow, there's a lot of people that expect things to be cut a significant amount. So, over just under 60% of the people think it's going to be between 400 and 450 basis points, where it's sitting at 550 now. So that's what we pay attention to and what we're looking at. And when we talk about the market and their feeling and sentiment, that's why if there's a comment made at 2:30 that kind of says, well, we're not even going to start thinking about cutting rates until we see blank, or it looks like a soft landing, so we can, be cautious. Don't think we're going to cut rates as aggressively as we think. Or they may say something crazy like, hey, we're not done increasing. We have to take a look. Inflation isn't exactly where we need it. We have to see what's going to happen in the spring. Those are the things that a couple words like that. And then all of a sudden you could see rates, kind of going into, we'll call it wonky territory. It's a technical term where things are going to get a little bit wacky for a little bit.
Or what do we call that? The mountain of skulls. Just
the mountain is like
exactly.
Golgotha.
Yeah.
Man, yeah, this is crazy. I just want to meet the 1.6% of people who think there's going to be a rate raise on Wednesday of this week. So I guess
there is a camp that's out there that still thinks we're not done with inflation. There's a camp out there that people believe that we've crossed a certain threshold and we're going to see some more pain, especially around shelter, and there may be more of it. We'll see what it looks like, but it definitely looks like things are looking more like a soft landing. It looks like there's going to be some cuts next year. To this extent, I don't believe so. So we may see some kind of, like say, a little bit of bouncing around in mortgage rates. Because again, these are short-term rates. This is Fed rates, not mortgage rates. But the market reacts to kind of these Fed rates and where the future of rates are going. So
So let's talk about that delta between the 10-year and your average 30-year mortgage rate right now. It's a pretty, by rate, it is 325 basis points right now, which I gather is quite high. Even if we don't see the Fed funds rate come down very quickly or very much, should we expect to see, with some stability, like should we expect to see a reduction in that delta? Is there going to be a convergence play there?
There should be, and I would say that there's some tightening to be done in that spread. But I'd be very cautious. A lot of people talk about that spread all the time, and they use it like it's a static number. But the costs of getting a mortgage have gone up significantly. We talked about this before. Like when I started in the business, G fees were 19 basis points to rate, and now they're staring at upwards of near 60 basis points to rate. So when we talk about spreads to rate in terms of G fee and what Fannie and Freddie charge,
I didn't know that. That's crazy.
Yeah. So what they charge, and that's not a price. That's to rate. Straight on the coupon. So that part of it, we talk about stuff from the 80s and 90s and you start tracking the spreads of the primary mortgage rate, like that doesn't equate or doesn't take that into consideration in the spread. So can the spread be a little wider? Yes, it's going to be a little bit wider because of the insurance and the costs of doing mortgages today is a lot different post-crisis than it was pre. And that's just the way it is. So, but yeah, the spread should tighten. It should, get in something sub threes. That's where you would think where there's some stability. And then right now there's a lack of premium. It's the same story we've been talking about for 3 years or 2 years. That premium, like in 2020, and again, I know I've mentioned this on here before. In 2020, like the lowest paying, like the coupon that paid the least out there was paying 103 or 3%. And today the highest paying coupon is paying like 102.5.
Mm-hmm.
So like there's a big spread, big difference the way it was when the Fed was buying. We knew there was buyers and there was lots of premium to be had versus now where like nobody really wants to invest or pay a lot of premium for a loan thinking that rates are going to come down. And there's a potential for them to refinance or prepay much faster than anticipated. So those speeds are in question. Nobody wants to go out on a limb and pay 104, 105 for a mortgage these days. So that part of it is a different dynamic we're not used to. And obviously a lot of foreign entities and people aren't buying as much. So there isn't as much demand. So that's something that we have to pay attention to, where maybe there's a whole kind of shift in the mortgage market and how premiums are done and how margins are set, because there just isn't this robust amount of premium going around so people can get their significantly higher than UMortgage costs. Obviously our costs are much lower, but the higher cost that it does to do a mortgage to get that covered in the premium. So that's something that is a dynamic that's new to all the tracking that we're seeing.
Wow. Company man through and through. Look at that. Just like the UMortgage plug right in there about how we're systemically better than everybody else. I mean, you can't deny it. Super enlightening there, Rob. That was actually so educational. As far as how, the rest of this week will go, is there any chance that CPI that comes out tomorrow factors into Fed's reaction on Wednesday, John, or is it?
I think they've already made their decision. I think it's gonna be flat. I mean, I think they're already anticipating a flat number, and they're just gonna march as is and keep it going. I agree with everything. Let me say it like this: the gospel of Rob. I'm an apostle. I believe in what he was saying. So let's go with that.
Yeah, sure. Well, I do as well. Besides those two things, I don't really know what the rest of the week holds for us. We've got some jobless claims as usual. We got treasury auctions today. I don't want to belabor it. Maybe some other time we could talk about some of the interesting notes behind treasury auctions that have sort of been talked about. The Wall Street Journal put out an article today about entitled "Why Treasury Auctions Have Wall Street on Edge." I think we're nearing the end of our time, so I'll have to leave us on a cliffhanger for that one. Did you guys get a chance to read that article or read articles like it?
I've definitely done some reading on it. Not that particular article, but certainly we'll weigh in on the next one. We can see that for next week.
Sure. Yeah, I think it's super fascinating. And definitely something that I could use some illuminating on. But before we go, any new products, processes, partners we should be on the lookout for this week? This is generally typically the time in the show where we reward the watchers who have made it through my ramblings with a morsel of information.
I think it's more my ramblings this week. But yeah, I think we have a lot of good stuff in store. We have a couple of interesting investors coming on board for some new product lineups, some stuff going around.
We're talking like non-QM or jumbo or conventional.
Yeah, some non-QM, some foreign national programs. So we're excited there. Definitely in the non-QM space, we have some great lenders that we're bringing on. Our poor lender management department is getting overworked here. So we're trying to bring on as many new products as we can for originators. We know it's coming. We know the spring is going to be interesting, and we're going to have to find alternative mechanisms to be able to lend out. And there's some really good products that make a lot of sense for us to go in. And I'll just leave one item out for everybody too. Is I think it's right now with how things are moving and how this par coupon has shifted down a little bit, and we're in a really good spot pricing wise. Is to just really pay attention and open up your rate stacks.
Open your rate stacks, guys.
It's we've talked about it ad nauseum. I know, I get it, but we still see locks come in and see stuff come in where an eighth lower is actually a better price for the borrower.
I've seen it a half point lower is better price for the borrower. It's insane. It makes no sense.
And it's not a normal thing. And this is basically how the buy up and buy down grids are working right now in conventional. You're going to have these anomalies and servicing values. There's a bunch of factors. On Ginny, it's the same thing. There's a couple rates that if you pay attention to it, there's some servicing opportunities there and value in the servicing. And these people can shift down in coupon. We won't get into it too much. All you have to know is that you got to open up the rate stack and pay attention. I'm not a proponent of discount points in this current environment. However, when there's dollar for dollar value and you can have a recoupment period that's basically 12 months or less on some of these occurrences, then it's worth it.
The right thing to do. Yeah, absolutely. I remember when I used to be able to just calculate the difference in rates in my head. If I could tell you the amount of discount points it would take to get from, at the time, say 4.5 to 3.875. Now, I mean, it's just like a crapshoot. It's like your drunk uncle.
It's wacky, and it's and all you have to do is open it up, and every lender is treating the different spots differently. So it's lender by lender, and having that optionality is really important.
Well, guys, yet another successful Monday market update. I learned something. Hopefully you guys out there in TV land learned something. If you have any questions for Rob, John, or clearly myself, the true expert, feel free to drop them in the comments, and we will get back to you. We'd love to take any questions for future episodes as well. Always happy to answer what's on you guys' minds. I hope you guys have a fantastic day. Let's all go get some loans. Thanks, gents.
Thanks.
Thank you.